Hello, everyone. Welcome to the Capital Intelligence Channel. Today, we're asking a pretty huge question. Why do massive institutions consistently beat the market, and what is the hidden machinery actually driving their success? In this explainer, we are unpacking the modern stock market to uncover the exact architecture of information asymmetry. Seriously, it's wild to see how the so-called smart money leverages resources, data, and just sheer computational power to secure a massive structural advantage over everyday investors like us. So here is our roadmap for today's explainer. First, retail versus the institutional edge. Second, the alternative data revolution. Third, AI and algorithmic trading. Fourth, mastering the mosaic theory. And we'll wrap up with the future of alpha. All right, part one, retail versus the institutional edge, the great divide. Let's just lay out the fundamental structural differences between everyday traders and the big institutional giants. On one side, you've got the typical retail experience. What most of us do, right? We trade our own money, we read public SEC filings, look at earnings reports, maybe use some standard technical indicators. But on the other side, you have institutional investors, commercial banks, pension funds, hedge funds. They aren't just trading a few shares, they're pooling massive amounts of capital to execute block trades, often 10,000 shares or more in a single shot. And it's not just about the size of their wallets, it's their infrastructure. They have entire dedicated risk management teams and proprietary research departments built for one single purpose: finding an edge. And this structural advantage, it extends directly into the market's plumbing. Institutions don't just route orders like you or I do on a basic smartphone app. They use alternative trading systems or dark pools to move huge blocks of stock without tipping off the broader market. The smartest firms use advanced infrastructure to analyze the complete journey of an order, understanding what wasn't filled, where orders went, and why. By optimizing their routing to avoid trading against someone who knows more than they do, they are literally capturing an $11 billion execution opportunity. And they do this before the public even sees the price tick up or down. Moving on to Section 2, the alternative data revolution, or as I like to call it, the eye in the sky. As basic financial data became totally democratized and available to everyone online, the institutional edge had to pivot. Today, hedge funds are essentially tracking physical truth from space to anticipate economic shifts way before a quarterly earnings call happens. Frankly, it is mind-blowing to see what they're looking at. We're talking about commercial satellite imagery with 50-centimeter resolution. They actually count the cars in retail parking lots to predict quarterly sales. They track global shipping flows across the oceans. They monitor crop yields, and get this, they even measure the shadow lengths on floating roof oil tanks in places like the King oil field, just to determine global oil stockpiles. And this really illustrates just how absurdly creative and honestly a little invasive this data gathering gets. Back in 2019, an analyst literally tracked a corporate private jet owned by Occidental Petroleum. By tracking its transponder signal using obscure but public antenna data, they spotted this jet landing at an airport in Omaha. The analyst deduced, correctly I might add, that Occidental executives were secretly meeting with Warren Buffett to secure financing for a massive acquisition. That single flight path successfully predicted a $38 billion mega deal. Let's look at how this plays out with global supply chains. By analyzing unstructured shipping data, things like bills of lading and shipping manifests, institutions can watch the physical flow of goods in real time. Take a company called LCI Industries, for example. Analysts saw their metric ton supply chain growth turn sharply upward in late 2018. But here's the kicker. That growth didn't actually show up as cash flow on the company's financial balance sheet until May of 2019. Talk about a massive head start. So the real takeaway here is that tracking this alternative data side by side acts like a crystal ball. When you compare actual physical shipments to reported financials, you spot what the pros call negative divergences. So say a company's stock is flat or even rising, but their physical shipments have tanked by 30% over the past year. An institutional analyst sees that deteriorating reality instantly. They can short the stock way before the everyday retail investor, who is stuck looking in the rearview mirror at last quarter's polished earnings report, realizes the business is actually in trouble. Okay, Section 3, AI and algorithmic trading. Enter the machines. Now gathering all this physical data is only half the battle, right? The real advantage is synthesizing it at lightning speed. We are way past simple moving averages here. The cutting edge relies on multi-agent AI frameworks, like the SafeN project. SafeN uses highly specialized AI bots. You've got a market agent crunching technical indicators. You have a news agent reading global headlines for sentiment, a satellite agent translating environmental data into financial signals. And finally, all of this is fed directly into a master agent that acts like an orchestra conductor. Instead of relying on old-school rigid algorithms, these systems use large language models to fuse all this multimodal data together seamlessly. It weighs the market data, the news, and the satellite intelligence all at the exact same time. Then the master agent outputs a highly confident narrative in plain language, wrapping up with a strict automated command: buy, sell, or hold, complete with a confidence score. It is cold, explainable intelligence operating at a scale that human analysts just literally cannot match. Which brings us to Section 4, Mastering the Mosaic Theory, the legal tightrope. Now, you are probably asking yourself, with all this tracking of private jets and parsing of satellite data, how is this even legal? Well, it all comes down to the Mosaic Theory. This is basically the legal art of gathering seemingly meaningless bits of public data and combining them with non-material, non-public info. On their own, none of these little fragments mean anything. They wouldn't move a stock price. But when you stitch them together, like a giant puzzle, you get a comprehensive, highly profitable, and perfectly legal investment picture. And regulatory bodies actually recognize this. The CFA Institute explicitly protects this practice, stating that financial analysts are totally free to act on this mosaic of information without risking a violation. Think about it. If a CEO just handed an analyst the final conclusion, that would be illegal insider trading. But because the analyst did the investigative legwork to build the mosaic themselves, it becomes a legally protected edge. Let's walk through how this actually looks in practice. Imagine an analyst notices public shipping data showing a huge surge in exports from Taiwan Semiconductor. Next, they scrape LinkedIn and see a massive spike in AI job postings at a specific US tech company. Then they do some digging and learn a tiny non-material fact. Senior management at that tech company just canceled their upcoming vacations. Finally, flight tracking shows the CEO's jet landed in a remote city where a major software firm is headquartered. Any of these alone? Nothing. But together? Boom. The analyst confidently buys call options, predicting a major acquisition before the public has a clue. But impartially speaking, this creates a seriously complex regulatory environment. The SEC strictly enforces Regulation Fair Disclosure, or Reg FD, so companies can't selectively whisper secrets to their favorite hedge funds. Institutions have to spend millions on compliance teams just to ensure their expert interviews and massive data gathering never cross that hard legal line into material insider trading. Basically, they have to ensure they're building a mosaic, not just buying a stolen painting. Finally, Section 5, the future of alpha, the new frontier. So, where is all of this heading? The arms race between retail traders and institutional giants is entering a wild new phase. We always hear this narrative that consumer AI is leveling the playing field for the little guy, right? But the reality is that the smart money has just moved the goalposts again. While retail investors get better at reading public earnings transcripts, the big institutions are investing millions into esoteric infrastructure, bespoke data pipelines, dark web monitoring, proprietary satellite networks, stuff regular people just absolutely cannot access. And guys, this is not a niche strategy anymore. Alternative data adoption is hitting 90% among investment advisors. Let that sink in. Paying millions of dollars a year for web-scraped data and satellite tracking isn't an optional luxury for a hedge fund anymore. It's literally the baseline requirement just to survive in today's market. Which leaves us with a pretty profound question to wrap up this explainer. As the informational divide shifts away from human intuition reading a balance sheet and moves entirely toward high-frequency data pipelines, autonomous AI agents, and orbital satellites, what is the everyday investor's place in this modern financial frontier? Can retail investors compete by playing a completely different, longer-term game? Or is the architecture of information asymmetry simply too deeply entrenched? It's definitely a lot to think about. Thank you so much for joining me today to unpack this, and I highly encourage you to keep questioning the machinery behind the markets.